Hello and welcome to this video session on IS 38 Intangible Assets. In this session we will cover the definition of intangible assets, its recognition criteria, in other words, can an expenditure be categorized as an intangible asset? Number 3, how an intangible asset is measured, in other words, how they are valued at the time of recognition. And lastly, we'll cover subsequent measurement of intangible assets. For example, how you would value it after it has been recognized, such as measurement at the end of accounting period. So let's start with the definition of intangible asset. What is meant by it? An intangible asset is an identifiable, non-monetary asset without physical substance. Some examples of intangible assets include computer software, patents, copyrights, franchises, publishing rights, goodwill, royalties. So what do we mean by identifiable? Now we are going to spend some time here because it is a bit important. So what does it mean? Well, it means that you can separate the intangible asset from the rest of the business. For example, you can sell the computer software without necessarily selling the entire business to which the software belongs. The same applies to patents, copyright, licenses, etc. But certain items cannot be separated from the business. In other words, you cannot sell them without selling your business. For example, goodwill. Goodwill of a business could be as a result of a combination of elements which have made the business successful. For example, an excellent management team or a customer list. If you want to sell the goodwill, you probably have to sell all the associated elements, which could mean the entire business. So in a sense, the internally generated goodwill, as we call it, cannot be categorized as an intangible asset because it is not separable from the business. However, there is an exception. Please watch this video till the end to find out more about it. Okay, so now let's look at the second element, non-monetary. What do we mean by non-monetary? Well, it simply means that it is not a financial asset such as investment in shares or loan notes. And lastly, without physical substance. Well, I think it is pretty self-explanatory, isn't it? It means that it is not physical in nature. You cannot touch it, you cannot feel it. For example, you cannot touch or fill publishing rights, but nonetheless, you certainly can use it to generate economic benefits. So does it make sense? Okay, so please remember these 3 key elements of the definition. Mind you that if an expenditure incurred does not meet the definition, it cannot be classed as an intangible asset. Now let's look at the recognition criteria. So why is recognition rules? Why are recognition rules so important? Imagine if the expenditure cannot be categorized as an asset, where would it go? Well, it has to go somewhere. It goes to the statement of profit and loss. It's recorded as an expenditure, which will reduce the profit, which is no good. We should not let anything happen to profits, right? Just kidding. But yes, it will go to statement of profit or loss and it will reduce profit. On the other hand, if it is recognized as an asset, well, the profit remains intact, the assets go up, the net assets go up, and wealth of shareholders will go up as well. Okay, so is meeting the definition of intangible asset sufficient for an expenditure to be classified as an intangible asset? The standard IS 38 says no. The expenditure will also need to meet the recognition criteria. Similar to other assets, intangible assets are recognized when the framework recognition criteria is met. And there are 2 main conditions. Number 1 is the probable future economic benefits. In other words, you should be able to generate some sort of economic benefits from the asset. For example, development or purchase of a computer software can help achieve better efficiency in operations, which may save time and other resources. Or in other words, better productivity, less operating expenditure, which means more economic benefits. And the second element of the criteria is the cost must be measured reliably. This means that can we reliably calculate the cost of the expenditure? Do we have third-party evidence to prove it? For example, an invoice. For certain items, it is possible. For certain items, it is not. For example, internally generated brand name cannot be measured reliably because we don't have third-party evidence to confirm it. Okay, so those are the recognition criteria. Let's now move on to the measurement of intangible asset. For measurement purposes, we can divide the expenditure in four main categories. Number one is externally acquired intangible asset. Number two is internally generated goodwill, brand name. Number three is internally incurred research and development expenditure. And number four is externally acquired goodwill, or as part of business combination, the goodwill that you acquire. The principles are simple. If you have acquired the asset externally, like license, copyright, computer software, it is recognized at cost at the time of acquisition. This would include the purchase price and any directly attributable costs, such as installation costs, legal or professional fees, cost of testing the asset, etc. So that's for the externally acquired asset. If the asset is internally generated, then measurement is a bit tricky because it depends on what is it that you have developed. Internally generated goodwill or brand name cannot be recognized, and therefore there is no issue of measurement of their cost. We know that goodwill cannot be separated from the business, therefore cannot be recognized, and brand names such as Google categories can also not be recognized because the cost of the brand name cannot be measured reliably. That is because if the company tries to value its brand name, there will be an issue of biasness. The value of the brand will be subjective rather than objective. So the brand name cannot be recognized, therefore there is no issue of measurement of it. However, say a company is trying to develop a product like a medicine or a production process for which it may spend thousands or hundreds of thousands of pounds. In some cases, the product may take or the process may take years before it is ready to be launched in the market or implemented in the production, for example. The sum of expenditure incurred on the research and development of such item can be quite significant. So how feasible and reasonable is it to show this expenditure as an expenditure statement of profit or loss until the product starts to generate income? Not quite, is it? Because it's going to be a long time. IS 38 provides a solution. It divides such expenditure in two key categories. The first one is research phase. The second one is the development phase. The research phase, this is the phase where the business is trying to gather knowledge of the product, process or system it is trying to develop. Now, by its nature, the research can go either way. It can provide some brilliant positive results, in which case the company will go ahead with the development of the item or the activity. Or it can produce negative results. For example, development of the product or process may not turn out to be feasible at all. Or there may not be enough interest in the market for the product. In short, since at this stage it cannot be demonstrated that development will result in probable future economic benefits, it cannot be recognized as an asset. Instead, the standard requires such expenditure to be written off straight away in the statement of profit or loss. The second phase is the development phase. If the research is successful, then the business will embark on the journey of development of the activity, the product of the production process, or the product, whatever it is. The standard requires that any expenditure incurred on development is to be capitalized. In other words, it can be recognized as an intangible asset rather than an expenditure in the statement of profit or loss. However, in order to be capitalized, it must meet this criteria. These are the conditions given in the criteria by IS 38. In short, we call it pirate. It's a numeric. So the conditions are, the first one, is the probable economic benefits. In other words, it is probable that the asset will generate future economic benefits, such as sales for the product being developed or reduction in the time of production process. The second is intention to complete. The company has intention to complete the development of the product and use it. Okay? Number three is resources available to complete. The adequate technical, feasible, financial and other resources to complete the development are available. Number four is ability to use or sell the asset. Number five is technical feasibility, which is to make sure that the item that we are developing is technically feasible. And lastly, expenditure must be measured reliably. Note that all of the above conditions must be met for the development expenditure to be categorized as an intangible asset. Okay, and lastly, let's talk about the externally acquired goodwill. At the start and in the middle of the video, we explored the issue of internally generated goodwill, and we know that it cannot be recognized. But what if the goodwill is externally purchased? Well, how can you purchase it if it is not separable from the business? Well, you're right, it can be acquired externally, but as part of business combination. When a parent company purchases a subsidiary, it may pay purchase price of more than subsidiaries and assets. In other words, more than it's worth according to subsidiaries' books. The excess amount paid is known as goodwill, and it is an asset for the parent company as it has paid for it. The excess amount paid, the goodwill, is a lump sum paid for the combination of subsidiaries' assets which cannot be identified separately, such as good reputation, excellent management team, client list, so on and so on. So you can see that even though subsidiary itself cannot recognize these items as an asset, as they are not separable from the business, but the parent can, because it is purchasing it, and therefore it can be said that the expenditure for parent can be measured reliably, and that is goodwill. The goodwill acquired as part of this business combination is always measured at fair value, not cost. Okay, so those are the initial measurement issues. Now let's move on to subsequent measurement. So the last issue we'll cover is of subsequent measurement. In other words, how these intangible assets are measured, say at the year end or after they are recognized. For this, we will divide the assets in two categories: assets with finite useful life and the assets with indefinite useful life. So the finite useful life first. Assets with finite useful life, such as development or a product with a reliably estimated lifespan, okay, or a license, those are amortized over economic useful life. Amortization is a term which is similar to depreciation. It is about systematically spreading the cost of an asset over its useful life. Usually the residual value of the asset is assumed to be zero. Now, on the other hand, indefinite useful life. If the asset's life is unknown, such as goodwill, it is not possible to spread its cost over the life. Right? So what can be done in this kind of situation? The standard requires that this type of assets should be tested for impairment annually or whenever there is an indication of impairment. Impairment means a sudden loss in value, one-off loss. The asset is carried at cost less any kind of impairment losses. Okay, so that was the year-end measurement. Let's quickly recap. Intangible assets are assets without physical substance and are non-monetary value. They can be recognized when the cost can be measured reliably and future cash flows are probable. Externally acquired intangible assets are measured at cost. Internally generated goodwill and brand name cannot be recognized. Internally incurred research expenditure must be expensed in the statement of profit or loss, and the development expenditure can be or may be capitalized if the pilot criteria is met. Goodwill acquired as part of business combination is measured at fair value. After recognition, the asset with finite useful life can be amortized, and assets with indefinite useful life are tested for impairment annually and whenever there is an indication. So I hope you have enjoyed this session, and I'll see you next time. Thank you.